You know, when you look at a giant company, you see one stock price, right? One single identity. But what if that's just the cover of the book? What if inside, some chapters are absolute blockbusters and others are, well, duds? Today, we're going full financial detective to uncover the real story hidden deep inside a company's valuation.
And that brings us to the central mystery we're trying to solve. How much is a company with all these different moving parts really worth? Answering that can be the key to unlocking some massive potential or, exposing a really fatal flaw.
So on the surface, it seems pretty simple. One company, one value. But the reality? It's way more like a puzzle with all these hidden pieces. Some of those pieces might be absolute superstars, while others are secretly dragging the whole thing down. And if you just rely on that single number, well, you could be getting a completely misleading picture. To solve this puzzle, we're going to need a case study. So let's meet our subject, a hypothetical, but very realistic, company we'll call Consumer Co. Okay, so Consumer Co. looks like your standard personal care giant. You've got the well-known branded products, think of the big-name creams and toothpastes. Then there's this huge private label business making store brands, a devices unit for things like electric shavers, and a trendy, fast-growing organic line. They all seem fine on paper, but the big question is, are they all creating the same amount of value for the company?
To find out, we need a special tool, kind of like a magnifying glass that lets us look deep inside the company. This method is called valuation by parts.
Sum of the parts valuation is exactly what it sounds like. It's a technique where you basically break a company down into its individual divisions and value each one as if it were a totally standalone business. You figure out what each piece would be worth on its own, and then you just add them all up. This is how you find out where the value is really being created and where it isn't.
And this isn't just guesswork, right? Our investigation follows a pretty rigorous four-step process. First, you get the mechanics down. Then you have to actually build separate financials for each business. After that, you figure out each unit's unique cost of capital. And finally, you do a reality check. You test your values against what similar standalone companies are worth in the real world. It's a thorough process for sure.
Okay, let's get to it. We've put Consumer Co. under our magnifying glass. We've run all the numbers. So what do we actually find?
And here it is. This is the big aha moment. This chart shows us the company's total value, but it's built up, piece by piece, business by business. And what's immediately obvious is that not all parts are created equal. I mean, not even close. Their contributions are wildly different.
Now, this is where it gets really interesting. Let's look at the story of the private label unit. It's a huge piece of the company, right? It brings in about 30% of all the revenue. But look at this, it contributes only about 10% of the company's total value. That is a massive, massive disconnect.
Let's put this in an even starker contrast. The branded products unit, it takes in $2 billion in revenue and creates over $5.1 billion in what we call enterprise value. It is a value creation machine. Now, meanwhile, the private label unit takes in $1.5 billion in revenue and creates just $1.1 billion in value. It's barely creating any real value for the company at all.
So you might be asking, what's the point of all this? This isn't just some boring accounting exercise. No, this analysis is the key to building a much smarter strategy, one with a much bigger payoff. It forces us to ask if the current strategy is even working.
And this leads us to the single most important question a CEO or an investor could possibly ask. Based on everything we've just seen, is Consumer Co. actually investing its money in the right places? Is it funding the businesses that are creating the most value?
And wow, this slide just brilliantly illustrates the core problem. On the left, you can see where Consumer Co. has been putting its money historically. A huge chunk, you'll notice, has gone into that low-return private label unit. Now, look at the chart on the right. That's where the value is actually created. It's a fundamental misalignment between where the money's going and where the real opportunities are.
So here's the strategic misstep, spelled out nice and clear. Consumer Co. has been handing out its precious capital based on size, not on performance or potential. It's pouring money into its biggest but lowest return business, while starving its smaller, high-growth, high-return units, like the organic products division. In short, they're funding their past, not their future.
Let's move to our final clue in this investigation and see how this all builds, because this deep analysis actually helps us bust a very common myth in the world of finance.
So a common theory for why a company like this gets a low valuation is something called the conglomerate discount. The idea is pretty simple.
The market gets confused by these complex companies with lots of different unrelated businesses, so it just marks the whole thing down. It's like a blanket discount just for being complicated.
But the research here challenges that idea directly. It says that in their experience, whenever you actually dig into the numbers, you almost always find a much more specific reason. The company's individual business units are simply underperforming their standalone competitors when it comes to growth or returns.
And that is our final verdict. It's not that the market dislikes Consumer Co. for being diversified, it's that the market can see the underperformance that's hidden inside its portfolio. It's not a diversification discount, it's a performance discount.
And that leaves us with one last thought. This kind of analysis, it's like giving managers and investors X-ray vision into a company. It lets you move beyond that simple single stock price and reveals the real engine underneath. So, the final question is, now that you can see exactly where value is being created and where it's being destroyed, what would you do first?